Hello, everyone. Happy Tuesday. Hope everybody's having an awesome day today. Welcome to our Tip Thursday, doing this on a Tuesday because of the holiday this week here in the US. But our topic today is actually very appropriate given that we are coming up on the holiday when a lot of people start thinking about donating to charity and giving back, and also coming up on Giving Tuesday, which is a day when a lot of places are reaching out asking for charitable support, and a lot of people are making donations. So today's topic is all about getting those tax breaks every time you donate to charity. And I wanted to talk about this one not only because of Giving Tuesday and the fact that this is a big time of year for giving money, but also because there's a lot of misconceptions around the tax break for charity. And, a lot of people will say, oh, I'm going to give, a lot of money as we get to the end of the year because I'm going to get this really big tax break. It's going to be great. May not be that simple. And so we're going to talk about all the rules today. But I want you to pay close attention if you're thinking about giving to charity this season, or if you've just been looking for ways to lower your tax burden. This might actually be a good option for you. It's not necessarily a bad choice. It just depends on everybody's individual situation. So hold on. All right, going to sit up here. As I'm going through this, if you have any questions, feel free to post them in the comments. But let's go ahead and dive right in as soon as I can figure out how to share my screen. All right, here we go. So first and foremost, let me just say that I think giving to charity is a really important thing. I think if you're in a position where you can make a charitable contribution, it's a really critical thing for all of us to do, because we know that the world that we live in is massively unequal. It's massively inequitable. And there are a lot of folks out there who really need the assistance because of the imbalance in our society when it comes to wealth and money and equity and resources. So if you're thinking about giving to charity, I commend you. I think it's a really important thing to do. It's something that I personally enjoy doing throughout the year. It's a big part of our household budget. We build it into our budget. And we actually, like I said, we do it throughout the whole year. I'm actually a huge fan of giving every single month. So setting up monthly recurring contributions, it makes the monthly outflow a little bit less painful from a budgeting perspective, but it also allows me to give the amount of money that I want to give over time. So the good news is you potentially can get a tax break if you donate to charity. So let's go ahead and just dive in and check out some of the rules around that, because it is often confusing exactly how you can get that deduction. So there are generally three types of things you can donate to charities to potentially get a tax deduction. The first is money. So this would be cash, a check, a credit card, whatever it may be, but giving actual money. The second would be goods. So think of, these are your goodwill donations. You're donating furniture or maybe a car or some clothing. And then the third would be stocks or investments, anything of value that is, an illiquid asset, but something of value that the charity can benefit from. So what actually qualifies as a charitable contribution? This is really important to understand these rules because, and I'll tell you in a second what one of the biggest misconceptions about charitable contributions is. But first and foremost, it has to be money or property, something of value that you're giving. It has to be given to a qualified organization, which you can go figure out if a charity is a qualified organization by going to irs.gov/TEOS. And it can't be set aside for use by a specific person. So remember, the whole concept of charities and nonprofits is that no one individual no one individual can benefit specifically. It's not for the benefit of one individual. It's for the benefit of a community or, a society as a whole. There are some things, though, that don't qualify for the tax deduction. And this is really important. Again, I mentioned some of the misconceptions that come up here. And actually, I want to point out, too, let me look at my next slide, because I don't think I mentioned this on the next slide. Let's go back 1 second. I said not set aside for use by a specific person. This also means that you cannot donate amounts you give to a GoFundMe, or if your neighbor is in trouble and you give them some cash. That is not a tax deduction. It's not given to a qualified organization, and it's specifically benefiting one person versus a charitable purpose. So, I get this a lot. I have a lot of clients who I'll look at their numbers and they'll say, oh, I gave this much to GoFundMe or to, some similar fundraising vehicle for an individual person. But again, because it's a fundraising vehicle for an individual person, it does not qualify. So what else does not qualify for the tax deduction? Well, there's actually a bucket of organizations that don't qualify as charitable contributions, or charitable organizations. So for example, civic leagues, sports and social clubs, labor unions, chambers of commerce, none of those qualify. Foreign organizations, it's got to be a U.S. based, with the exception of Canada, Israeli, and Mexican charities. We have specific tax treaties with those countries to actually count those as tax deductible, with some additional rules, but generally speaking. You can't get a tax deduction for a contribution made to any group that's run for personal profit. So again, this goes back to that idea that no one individual can benefit personally. You also don't get a tax deduction for a contribution to a group that lobbies for law changes. So, and along that lines, it's the last bullet, but political groups or candidates for public office. So again, anything that is, pushing for something to change, in that sense, like pushing for new laws or a politician who's running for office, that stuff doesn't count. This is why, if you've ever worked with a nonprofit, you may be familiar. The nonprofits are very strict about making sure they don't violate the lobbying rules, because they don't want to end up in a position where they're no longer allowed to take tax deductible charitable contributions. Homeowners associations are not charitable organizations, and then individuals. I mentioned this. This is the GoFundMe issue that everybody has, but donating to individuals is not tax deductible. Another one that comes up a lot of people don't realize this, are raffle, bingo, or lottery tickets. And the raffle tickets one throws a lot of people off, because a lot of times you'll go to a charitable function, like a gala or some other event, and they'll sell you raffle tickets. And they'll say, we're raising money for our organization. And the organization itself may be a qualified charitable organization, and donations to them otherwise may be typically tax deductible. But raffle tickets aren't, and the reason is because you are getting something in return. You are essentially buying a chance at winning an item of value. So raffle tickets, lottery tickets, again, same thing, don't count for them. You also can't deduct dues, fees, or bills paid to country clubs, lodges, or fraternal groups. However, you may be able to deduct membership dues to other qualified charitable organizations. So it just depends on the type of organization it is. If it's a country club, no. If it's something like Sierra Club that's fighting for environmental action and change, then probably yes. And lastly, you cannot deduct the value of your time or service. So if you do a lot of volunteer work for charities, thank you. That's really important work. But you can't deduct the value of it. I had a great client asked me the other day, she said, I'm doing some work, I'm doing some website design for a nonprofit. Can I deduct the value of, or she didn't even ask, can I deduct it? But she asked, how do I report that? How do I record it? Do I recognize it as income, or how does that work? And, I said, no, because they're not paying you for it. And so you both don't have to recognize it as income in your business, but you also can't deduct it as the value of what you've given them. That said, if you do volunteer your time, or service, you can deduct out-of-pocket expenses. So if you are, volunteering with an organization and you go buy some supplies, you can deduct that. So there may be expenses that you can deduct related to that volunteer time, but not the actual time itself. Now, the question always comes into play, well, how much can I actually deduct? So you're normally limited to 60% of your adjusted gross income. Now, your adjusted gross income is a number on your tax return that we get to after we add in all of your income items and then certain deductions and adjustments to income. I'm not going to go into what those specifically are today, but if you look at your prior year tax return, you'll be able to find that line item for adjusted gross income, and that'll give you a sense of how that number is calculated. So typically limited to 60% of your adjusted gross income. For 2021 only, because of the COVID-19 pandemic, they passed some charitable contribution rules that really kind of expand or exceptions that expand the rules, I should say. So in 2021 only, 100% of the gifts that you make to qualified charitable organizations are deductible, if you give them in cash. And when we say cash, we mean cash, credit card, check. So it doesn't have to be physical cash, but if you're giving them money versus giving them goods like a sofa or clothing or stocks or investments. Again, that's usually 60%. It's 100% for 2021 only if the gifts are in cash. Cash, check, credit card. Now, there's also a limitation. This is not specific to 2021, but there's also a limitation that the deduction may be limited to 20%, 30%, or 50% of your adjusted gross income, depending on the type of property you give and the type of organization you give it to. I'm not going to go into all the rules today. There are some very specific ones. You can go to the IRS's website to find out this information. But this tends to be the case if you're giving, I mean, we're not talking about when you're giving cash or, credit card donation. We're talking about when you're giving specific types of property. There are some specific rules. So just keep in mind that there could be a limitation here. And this is that first point at which you want to say, well, once you confirm that what you've given is actually a qualified charitable contribution to a qualified charitable organization, this is really that first point that you want to make sure, if I make this big financial contribution to a charity, is it even going to be deductible? Is it within the income limits that I've spelled out here? So that's the first thing you want to check, is just make sure that you'll even be able to take full advantage of the contribution that you make. Now, if you are limited because of these rules, you can carry over your limited deductions for 5 years. So if you can't use the full deduction this year, you can carry it over next year and so on for up to 5 years. But again, if you're limited, you're pushing off the benefit of that deduction. You may be okay with that, but keep that in mind when you're thinking about giving something this year. Do you want to maybe give a little bit less this year and give more next year? And also make sure that if you are going to carry it over, that you can use it up within those 5 years. Now, this comes up a lot because a lot of clients don't realize this, but this is when you give a charitable contribution and you get something in return. So a great example, I went to, a few weeks ago, I went to a dinner at a local farm. It was fabulous. The food was incredible. And we paid to buy a table at this dinner. We cannot deduct the entire cost of that table because we got something in return. We got an event ticket, we got food, we got drinks, et cetera, et cetera. So you can only deduct the amount of your contribution that is more than the value of the benefit you received. So let's just say that I paid $500 for the table and the value of that dinner was $300. I could deduct that additional $200 because I paid $200 more than the value of the item that I received. Now, you don't have to reduce your deduction by the value if it's a token benefit. So when we say a token benefit, we're talking about something that has very, very minimal value. This would be like a pen or, something promotional in nature, or something that is just, if somebody gives you, if you make a contribution and they send you like a little bumper sticker, that would probably be considered, having a token value. So that's not, your deduction is still fully deductible as long as it falls within the other rules, as long as the benefit only has a token value. And the organization must inform you of this and tell you that you can deduct your contribution in full. So you don't get to make the conclusion or the decision that the benefit is token in value. It's up to the organization to tell you that. Similarly, if you do contribute and get something of value that's not token, so again, the example I gave of the dinner I went to, the organization is typically going to send you a letter or an email that says, you gave us X, the value of this was Y, therefore you do the math and that's your deduction. This comes into play a lot too when folks do silent auctions or live auctions at events, fundraising events. If you go to a fundraising event and you bid $1,000 on a trip, let's just say, and you win it, you don't get to deduct that $1,000 unless that's more than the value of the trip, and only then you can deduct the difference. So if the trip is worth $800, you paid $1,000, you can deduct $200. But if the trip is worth $1,000 and you paid $1,000, no deduction. And if the trip's worth $1,500 and you paid $1,000, no deduction. So it's only that difference that you can deduct. Now, let's talk about documentation, because this is another big thing when we're talking about charitable contributions. And candidly, a lot of folks don't do this or aren't aware of the rules. So we're going to talk about them so that moving forward, you can be in a better position in case you ever get audited. Okay, so when it comes to a cash contribution, and again, when I say cash, I'm talking about cash, check, credit card. you need to have some verification of the transaction. So, for example, you could have a bank record, which would be a canceled check, a bank statement, a credit card statement, or a receipt for any kind of an electronic fund transfer, excuse me. So some kind of bank record. You could also have a receipt from the organization. That's probably one of the best forms because it's going to say their name, it's going to say the amount, it's going to say the date, it's going to say that they're a qualified nonprofit organization. And if you have charitable contributions taken directly out of your paychecks, sometimes folks will do that. You would just need to show payroll deduction records. So any one of these will suffice, but make sure you have this documentation. If the amount is for more than $250, you must have written acknowledgement from the organization that shows the amount that you contributed, whether you received anything in exchange, and then the date that you made the contribution. And if you don't, it doesn't have the date on it, which it almost always does, but if it doesn't, you need to have bank record support as backup. Now, if it's a non-cash contribution, the rules get a little bit more confusing. So if it's non-cash less than $250, so again, let's say clothing or a piece of furniture, books or something like that, you need to have some kind of a receipt showing the name and address of the organization, the date and location of the contribution, description of the property, and then any specific details that you can provide if it's a security. So like a stock, for example, or a bond. Now, if you go donate something to Goodwill, they always have the blank pieces of paper that they hand you, which have their name and address on it, but you fill out the date and the description of the property. That's sufficient if it's under $250, because again, this is all that's required. And it's okay if you're filling out the date of the contribution and the description of the property. The organization doesn't have to do that, but you've got to have something with their name and address. So that's why Goodwill does that. Now, if it's $250 to $500, you have to have written acknowledgement from the organization. So if you donate, some furniture or some art or something like that, and it's $250 to $500, you can't just drop it off at the back door of Goodwill. You need to get the organization to actually acknowledge that you've donated this and have them give you that acknowledgement so that you can have that documentation. If it's between $500 and $5,000, you have to complete tax form 8283, which basically just asks a bunch of questions about what you donated and the value. And you have to still have written acknowledgement from the organization. So that requirement doesn't go away as we get higher in value. And then lastly, if it's $5,000 or more, you've got to have that written acknowledgement again, but you also have to have a written appraisal of the property. So if it's over $5,000, you've got to get an appraisal. It's got to be in writing. It's got to be from a qualified licensed appraiser. And you have to fill out, again, that form 8283, that tax form, to provide all of this information to the IRS. So it gets a little more complicated if it's not cash once it gets over $250. Now, how do you actually get the tax deduction? Well, excuse me, you take it on your tax return. And typically, you can only take charitable contributions as deductions when you itemize your deductions. So if you're unfamiliar with this concept, on your tax return, on your personal tax return, you have the option to either take the standard deduction or to itemize your deductions. Itemizing your deductions means listing out all of the different allowed deductions and the amount. So things like mortgage interest, property taxes, state and local income taxes, or other state and local taxes like sales taxes, charitable contributions, casualty losses. Let's see what else. Those are kind of the big ones. Medical expenses falls into that bucket too. So if you have enough expenses to exceed the standard deduction, then you would itemize your deductions so that you could take all of those deductions on your tax return. Most people take the standard deduction because the standard deduction is pretty good. It's a little over $12,000 for a single individual. And it's about 25, what is it, 25.2, 25.5 in 2021 if you're married filing jointly. And it's like 18,800 if you're, don't quote me on those numbers, I'm close, if you're head of household. So the standard deduction is a pretty decent number. So most people end up taking that, which means that they don't itemize, and therefore they can't take a deduction for their charitable contributions. Because the idea being that that standard deduction amount, it kind of encompasses all of those deductions that you would otherwise take if you itemized. However, In 2020 and 2021, again, because of the COVID-19 pandemic, there was a special exception for folks who did not itemize, meaning you took the standard deduction, to allow you to still take a deduction for charitable contributions. In 2020, it was $300 total. In 2021, it's up to $300 per taxpayer. So if you're married filing jointly and each of you donates at least $300 in cash, again, cash being cash, check, or credit card, to a qualified nonprofit, each one of you can take the tax deduction up to $300. So potentially a $600 tax deduction in addition to your standard deduction. But again, this is only happening in 2021. It's going away. It was because of the pandemic. So this is a potentially great option for you if you want to give a little bit more this year, or if you always give and you haven't been able to specifically take those deductions in the past. So the question always comes up then, should I give charitable contributions before year end? And the thing I like to remind folks is, look, charitable contributions are not a dollar for dollar tax deduction. And I say this with a little bit of pause because I really do think giving to charity is a really important thing to do. And I want you to do it as much as you can. But I don't want you to do it necessarily just for the tax deduction. Giving money to charity is not a dollar for dollar reduction, meaning if my tax rate is 20%, and I give $1,000 to charity, I'm only going to save $200 on my tax bill, 20%. So it's not worth giving $1,000 to save $200 if that's the only reason I'm doing it. Now, if your tax rate is 35%, 40%, if your income's pretty high, all of a sudden it starts to look better to do that charitable contribution for tax purposes, but it's still not a dollar for dollar deduction. If your tax rate's 10%, 15%, like it is for a lot of you, you're not really saving that much money. So should you give them before year end? Absolutely, because the charities need you to. But should you do it because of the tax deduction? That's an open question that really depends on your tax rate. And again, even at that highest tax rate, it's not a dollar for dollar deduction, so it may not be worth it. All right, my friends, I am going to leave it there. I want to remind everyone that spots are opening up next Wednesday, December 1st, for our 2022 annual tax prep package, as well as our 2021 tax prep only package. You can grab your spot by going to megkwheeler.com/tax. Everyone who joins our waitlist gets a special treat, even if you don't sign up for anything. So you definitely want to be on that waitlist. When you sign up for this package, you're going to get all your tax stuff handled, your tax return prep, your quarterly tax calculations. You're going to get lots of one-on-one time with me through tax planning calls and unlimited access to ask me questions. You're also going to get a membership to my Badass Moneymakers membership through the end of 2022. So you'll definitely want to grab your spot on the wait list. Again, you can do that by going to megkwheeler.com/tax. And we are sending out that email next week. So you got to get on that wait list by Sunday night, actually Sunday the 28th, to get that special treat. Otherwise, you're going to miss out on that. Again, you can do that by going to megkwheeler.com/tax. I will see you all back here next week for another Tip Thursday. Have a wonderful week. If you are celebrating or honoring Thanksgiving, please just remember the origins of it and the true meaning of it, and honor the land that you're living and working on. And I will see you all back here next week. Bye.